Hello, everybody. My name is Luke, and we have an exciting session today. And today we're going to talk about everyone's favorite topic, and that's the United States tax code, U.S. taxes. I know everyone finds them riveting, but it's nice to meet everyone. My name is Luke, and I am an employee of Collective. And Collective, you can think of us as essentially an online back office, full service platform, full service financial platform for your business. So essentially, what we would do is the first thing we do when you came on board is, if need be, we'd get your business set up. We'd form an LLC on your behalf. We'd make an S corp election for you, and then now that you're an S corp, we'd handle your payroll as well. We handled monthly payroll and making sure that's organized. Then we would take over your bookkeeping. We'll force a full service bookkeeping company as well. So we'll give you your reports each month. And then you also have a team of experts that you can message at any time for support throughout the year, if you have any sort of financial questions or just need some guidance. And then at the end of the year, we will file your S corp tax return. Now that you're an S corp, you have a business return that you've got to file, and we'll file it for you. Anything that sort of in a tax context that kind of needs to be done for the S corp, Collective will likely handle. But today we are running a session called Tax Tuesday, and it's a fun little AMA session. Essentially, it's an Ask Me Anything session, and you can ask me anything regarding taxes, business finances. Maybe you have some questions about the new, FinCEN BOI report that the government is, wanting you to file. Ask me all those kind of questions. And I believe that we already have some come in, so we might as well just get to it. The first one is, in what situations can I take a loss from my S corp? Well, that's a really good question, and I get it asked to me a lot. When can I take a loss from an S corp? And conceptually speaking, when you're thinking of losses and how much you can take and whatnot, you need to think about your basis in the business, which is essentially another way of saying is you need to think about your total investment in the business. A loss, in terms of like what you can write off or deduct, you can only take a loss up to your basis in the business. So for example, let's say that in 2024, your S corp loses money. You distribute yourself money, you pay yourself money, but at the end of the day, the S corp loses money. You spend more in business expenses, the business itself, than you have in income coming in. So you can now record a loss. You can't book a loss yet, but you can record a loss, meaning once you file your tax return for 2024, on your S corp tax return, there will be a total carryover loss amount that now exists on that tax return. You can take that loss amount and carry it forward and sort of use that loss against future years of income. So as long as you have enough basis. So for example, let's say that let's say that in 2024, your S corp has a $20,000 loss, and that $20,000 exists as a carry forward loss on your return for 2024. In 2025, let's just assume that your S corp makes $10,000. It has $10,000 in positive net income. Since you have a $10,000 loss from last year, if you have enough basis in your business, if you have enough investment of at least $10,000 in your business, you could take that $10,000 loss, and you can essentially wash out your $10,000 profit for 2025. You can deduct it against it. So that's essentially how losses work. Now they can be complicated. Always, speak to, like, when doing these sorts of things, and in any other information that I share here today, always speak to a CPA, a tax attorney, or some sort of licensed professional before you do any of this stuff, because it's very complicated. It's very easy to mess it up. It's very easy to make errors, and it's very easy to be incorrect about what you think you can deduct or write off or carry forward. So it's a good idea to get some guidance. It was it was reported 140 million people filed yesterday. Does that slow down taxes? Yes. It does. Like, when the IRS gets an onslaught of returns, then yes, it can slow down taxes. How exactly do taxes work? How does the IRS process so much at one time? Well, that's a really good question. I haven't been asked that before. But the reason why they can process so much at one time is because they primarily use computers to do this. They use computers. They use machines to check your return and quickly analyze it. They do it in a specific way. And what they do is, when you get paid by people, by other people, by organizations, by whatnot, they are supposed, especially as a business owner, they're supposed to file 1099 forms showing how much they've paid you. They're supposed to file these forms both to you, they're supposed to give you a copy, and they're supposed to send in this information to the IRS. They're supposed to give the government a copy as well. So the IRS has this information reported under your name. They have it in your records. So for example, let's say that you have a 1099 contract with some company, and that 1099 contract is $120,000. That company has reported to the feds $120,000 under your name, under your social security number or your EIN number, to the feds. The feds know that you've at least made this much money. You then file a tax return, and you report that income. You report that $120,000 of income on your tax return. Let's say that you file your return, and you don't claim all that income that the IRS already has a record of. The computer will catch that, and it'll say, okay, the company said that this person was paid 120 grand, but they've only put a $40,000 gross income on their tax return. Something's wrong here. They're leaving out $80,000. So bam, the computer will generate a notice to you and saying, this is wrong. You owe us tax. You've underreported your income. Here's your new tax bill. Pay us money. So most of it is automated. Now, when it becomes a little bit more serious, sometimes agents can get involved. Actual people can get involved, like revenue officers, revenue agents, auditors, for people that are doing things particularly egregious that a human being needs to get involved and examine and investigate. So that's kind of the two ways on how the IRS processes returns and examines returns, both by computers and human beings. It's my first time filing taxes as a creator. What should I know? Well, there's several things to know as a creator. I guess one of the really important things to know as a creator when you're doing taxes, like an online creator, is there's some things that you think that you're able to write off, or that's acceptable to write off, that the IRS disagrees with, that the IRS has a different view of. And one thing or a few things that have been brought up to me that people are writing off as creators is a lot of fashion items. So for one, clothes. And before I say this, I'm not putting anyone down. I love clothes. I do. I spend money on clothes. But you're not allowed to write clothes off. Every clothes that you're able to wear every day, even if they're really nice clothes that you've bought for your business, because that you are able to wear them personally, and because they kind of have a dual purpose, the IRS does not consider those type of purchases as deductible. You can't write them off. Another thing is nails, manicures, and expensive um, paintings, or I don't know the lingo for painting your nails, but it could be expensive. Um, you can't write that off either, or you're not supposed to. There are some people that do, but the IRS just hasn't caught that yet on their returns. Technically, you're not supposed to write those sort of dual expenses off. So just keep in mind. Oh, here's a really good question. At what income bracket should you hire a CPA? Well, as much as I'd love to say that it's just simply about income brackets, it's not necessarily. I would consider hiring a CPA or some sort of tax person if you're self-employed. Even if you're not making a ton of money yet, even if you're making somewhere below 100 grand or whatnot, sometimes it is good to get some guidance from a tax professional um, to help you out with your stuff. Especially near the beginning when you're figuring out how to run a business and how all this stuff works. So as much as I'd love to give you kind of an income amount, I don't really think I can. If I had to, I would probably say, probably once you reach the 100 grand, $120,000 mark, it might be a good idea to really start um, considering getting some professional assistance with your finances. I'm on an H-1B visa and I have a W-2 job and run a side business. How can I navigate taxes considering I'm in H-1B? Well, what you'll do is you should, even though that you're on an H-1B visa, and again, I would check in on this. There's a lot of international tax implications that I'm not aware of. So before you do anything, speak to a tax professional that has experience in this. But essentially, you're going to do in the U.S. anyway. You should report things similarly to a permanent U.S. resident or a U.S. citizen. And essentially, you have a W-2 job and you run a side business. So you'll file a 1040 tax return, a personal tax return. And for your side business, you'll report that income and expenses on your Schedule C of your personal return. It's essentially your profit and loss statement. So you'll report that there. And then for your W-2 job, you'll just take that W-2 form that you get from your job and you'll just record how much taxes you have, or I'm sorry, how much W-2 income you've been paid and how much taxes that have been withheld from your paycheck and paid to the government. You'll report that on your return. And that's pretty much how you handle your taxes. What are some things we can do to avoid high self-employment tax? Well, there's a few things actually. One is an S corp. No, there are certain situations where, well, it's not certain. It's very common for an S corp to save you in the self-employment tax. That's one sort of main functions of the S corp. But also, though, another way to kind of avoid the self-employment tax is to become more involved in passive income activities. So things like owning stocks, bonds, certain types of rental properties in certain situations, passive activities are typically not subject to self-employment tax at all. Now, usually you can't, jump right into passive activities. You've got to make some money into active activities first to even have money to invest in passive activities. But long term, if you'd like to avoid the self-employment tax, then you can invest more in passive investments. Active activities, like active work, like running a business, doing something that involves your material involvement, that's typically subject to the self-employment tax. So keep that in mind. All right. How do S corps work? How do they save you in the self-employment tax? Well, they're before you become an S corp. Well, first, let's back up. Let's talk about what an S corp even is. Like, what does that even mean? There, before you even become an S corp, like if you're just a sole proprietorship or an LLC or anything like that, then a big chunk of your money is subject to the self-employment tax. Big chunk of it, and the self-employment tax is 15.3%. And what the self-employment tax is just Social Security and Medicare taxes. That's what that's what it means. Like when you hear self-employment tax, that's what that means. Is that 15.3% is Social Security and Medicare taxes. Before you become an S corp, either a huge chunk or all of your money is subject to the self-employment tax. So, like, let's assume that your net income is around, like $100,000, something like that. Before you become an S corp, like when you're just a sole proprietorship or an LLC, how you'd come up with your self-employment tax is you take $100,000 and you'd multiply it by 15.3%. Like all of your money subject to it. What happens with an S corp election, though? And note that I said election. That's what an S corp is. It's a tax election. So it's a way to ask the government to tax your business entity in a certain way. So you either have to be either an LLC or a corporation to even elect the S corp tax status in the first place. So, but when you do that, though, when you do make, let's say that you have an LLC and you file the S corp paperwork with the government, with the IRS, you become an employee of your own business. You become an employee of your own LLC or whatever entity you have formed. And since you're an employee of it, you'll now pay yourself a wage. You'll pay yourself a salary, just like you'd receive if you work for someone else, like as a W-2 employee. But the cool thing about S corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary amount. So let's say, like for example, let's go back to the 100 grand example. And let's now assume that this person's making 100 grand in total, but let's assume that they pay themselves like $40,000, something like that. With an S corp, that first 40 grand is now the only thing that's subject to the self-employment tax. I'm sorry, I got a little tongue-tied there. It's only that 40K that's subject to that 15.3% self-employment tax. The other 60K, or just the rest of your funds or the rest of your money outside of your salary, that's your business profit. That's the S corp profit. And that chunk of money is not subject to the self-employment tax any longer. So in a situation like that, like someone making that amount of money, they're saving around, I want to say, what is that? Like around $9,200 a year in the self-employment tax just by going S corp. Okay. What's the difference? What makes something a partnership? What's the difference between a partnership and an LLC or a corporation? Well, there isn't a difference between a partnership and an LLC because a partnership is an LLC. A partnership is a multi-member LLC, which means that you form an LLC and there's different separate entity people who are members of it. So it makes it a partnership. And the IRS just automatically considers you a partnership. When you form an LLC with your state of residence, and let's say that you add a partner onto it, the IRS will automatically require that you now start filing a partnership tax return. And it's called Form 1065. It's literally a partnership federal tax return. And that happens automatically when you do those reports. So that's what it means to be a partnership. That's what it is. And now that partnership return is due every year until you close down the partnership. So it can get a little complicated, partnerships and different business entities. So when you're dealing with that and need some help with that, it's usually a good idea to get some professional help. What's the difference between an S Corp and a C Corp? Really good question. Glad you asked. It's the difference. So, first of all, unfortunately, the IRS is not the best at terminology. Okay. How they choose to name things and whatnot is sometimes unfortunate. It doesn't make a lot of sense. An S Corp does not necessarily mean that entity is a corporation. Doesn't necessarily mean that. Different entities can elect S Corp tax status. Like I said earlier, an LLC can elect it. A partnership can elect it. A C corporation can elect it to become an S Corp. So the difference is an S Corp is a pass-through entity. I'm sorry, is a pass-through entity for tax purposes, essentially. So whatever the business makes passes through to the shareholder's personal tax return, is what that means for an S Corp. And it's only subject to income tax and self-employment tax. Corporations, C corporations, are subject to corporate income taxes, separate taxes from the shareholders, and they are subject to those federal corporate income taxes. They pay that tax rate. And then when money is passed down to employees of the corporation, shareholders of the corporation, whatever, stockholders of the corporation, then they pay personal taxes on that money again once it's paid to them. So a C Corp in a lot of situations has multiple layers and levels of taxation, whereas S Corps and don't. They're a pass-through entity. Why are taxes necessary? What do we use them for? Well, before I go on with this, I mean, a lot of these taxes probably aren't necessary, I guess is what you mean. Like, the federal government budget is very large. Like, there's a lot of stuff that they spend money on. But taxes go through a lot of different things. One, taxes fund our military, of course. So they build up the military. Taxes fund some road management, like especially federal roads. It covers that. Taxes cover social services, federal social services. There's a lot of things that taxes cover. And I have time for one more question here. With the tax season finally here, is it too late to become an S Corp? It's not too late to become an S Corp for 2025. So, if you think that an S Corp might make sense to you, if you'd like to discuss this more, reach out to us. Go to our website, schedule a call with one of our advisors, and we can, discuss, does an S Corp make sense? Is collective in your best interest? And we offer a free consultation in that regard. But that's all the time that I have today, unfortunately. I actually have to go and assist a collective member. But I had a blast like I do every week, and I hope to see everyone next week for another Text Tuesday.